Now, you all know that the insurance company, especially the one that I use, less than 1% of their portfolio is in the stock market. How secure are they? Let me tell you, they did have to lower dividends last year. A couple companies did. Every company has been lowering dividends. And ironically, if you look at dividend history amongst like 5 or 6 companies, they have all lowered dividends at least 9 times since 2008, I believe the statistic went back to. All these companies have done that. They all have the same pool of money to invest in. You want a company that has great vital signs, that understands where to put money. These companies are 200 years old. They know how to manage money for the most part. And I say that because we had a company, not my company, not a company I used, but there was a company in 2021 that demutualized. They were not doing good financially. I could see that on their vital signs, hence why I did not do business with them. They were already doing some things that were alarming. That was just poor management. That is why it is so important to write a policy with a company that's been around, that has good management. Just because you've been around doesn't mean that the old CEO has been around. So if we have a CEO that's not conservative, we have issues. If you are looking at an insurance policy from various companies and you're looking at the non-guaranteed side, and let's just use one of my companies, for example, One America. And then I might have a client that brings another policy to me from XYZ company that I will not name names. That company, their non-guaranteed might be significantly higher. How? Because they all have the same pool to invest in. They're all doing bonds. They might have some stocks. They may have real estate. And then they're going to have other things. So if we're going to have more money on the non-guaranteed side, are we over projecting? Are we putting more money at risk to earn more, which puts the company at risk? Are we dipping into reserves to illustrate that we're going to pay you more, but we don't actually pay you more, and it's a sales gimmick? If you're going to compare against companies, you have to look at the guaranteed side, not the non-guaranteed side, because companies can adjust that dividend and they can make it look fantastic. I use several companies, but the company that I prefer is One America because they are so conservative that they always kind of come in almost last as far as how much they're paying out. Because we want to keep in reserves. We want to be conservative and not overproject that, oh, how are we going to pay all these dividends? I know the CEO of the company. I know him. I have his cell phone number. I can call him. I can ask those questions of the financial department. I can ask all that stuff and I can get an answer in Mary Jo terminology. So the company is important. Do I see them going anywhere? No, I don't.